Okay, hello traders and welcome to another FX Evolution video. My name's Thomas Atkinson and today we're going to be covering a free guide to scalping during periods of high volatility. This is a system that we've used for years. It may seem very basic, but it works really well during these periods of time. So let's get straight into the video. Okay, well, here we have the VIX or the volatility index, and today is the 3rd of April 2020, but it doesn't matter when you're watching this video, the same principles will apply. Here we can see that the VIX went up to kind of like that 80 area, which is pre kind of GFC period. We've got some massive spiking in fear or volatility. We're sitting at about the 45. I guess our expectation is that the volatility will increase over the month of April as we see more economic data come out. So whatever instrument you are trading, especially if you're scalping, get your economic calendars out, Forex Factory, Daily FX, whatever website it's going to be. Doesn't matter whether you're trading S&P or a Forex currency or a commodity, and make sure you're aware of the news coming out, because even basic news is going to spike currencies and instruments a lot this month. There's a lot of uncertainties, so be careful about that. So now that we've covered the VIX, let's take a look at the strategy itself. Here we've got the S&P 500. Now, obviously, this is a 15-minute chart. When you're scalping, you're going to be down in the 15-minute, 5-minute, 1 minute. I know some people will claim scalps are only on 1 minute. In my opinion, if you're holding a trade, let's say for a matter of maybe 5 minutes potentially to a few hours, I'll consider them all in the scalping opportunities. And of course, day trading would be anything we're holding for that day or potentially quite a few hours. It kind of blurs the lines, but let's have a look at how we would get into positions. So I think the most important thing during these periods of time is we do have moving averages on the screen. The red one's the 20 EMA, the blue one's the 50 EMA, and the green one is the 200. However, price action or being able to read price is the most important part of all trading. So here we've highlighted a zone and we can see that it's been touched multiple times. We've also got a zone up here that's been touched. Now this may look like it's in history, but the principle is the multiple touches to an area. So if we have 1 touch, 2 touches, and 3 touches, this is incredibly important. This shows us that the market is considered this area. This area was a form of support. So it was a form of support and the market was buying off this zone. If the market closes underneath this zone during a period of high volatility, chances are something has changed that's significant. We really don't care what that is. But the most important thing is it has gotten through this zone. When it closes below this zone, usually it will come back and do what's called the conservative entry or the retracement. And it's this point in time that we want to scalp opportunity the market. So this is the US 500 again, 15-minute chart. We could look after the 3. So after we've analyzed, it's always important, the 1, 2, 3. Okay, we need 1, 2, 3 every time. We could short this market and we can sell it for the distance that we've seen up here, and that would be our take profit. Now, conversely, we've got 1, 2, 3 up here. Now, if it had broken to the long side, guess what? We would wait for the pullback and buy it. We don't care whether it goes short or it goes long. The importance is the 1, 2, 3. I'm going to continue mentioning that. You also want to make sure that the market is moving smoothly, as in it is moving in a trend or it is moving sharply in a direction every time it breaks. We're going to show the pound in a minute, the pound versus the US dollar, and we can see that it's very important to see the 1, 2, 3. Here over in this area, again, the 1, 2, 3 concept. We've got that first touch, second touch, third touch, and then we've broken through, pulled back, slightly gone a little bit higher, and then of course it's sold off with plenty of pips for us to get the opportunity in. Now, when we're selling these, we generally can have very tight stop losses. Let's say we choose to sell this position and we're using a 20 and a 50 moving average. There's a high chance or probability that you'll be able to put your stop loss behind the 50 moving average. Okay, this is the 50 moving average, and that generally will work out for you because remember, we're in a scalping environment. The idea is that the market is going to come down. In terms of where we set our take profits, we're going to want to look at the information that is above to see whether it can tell us something about where the future would go. So in this case, if we were shorting this market, we could say there's a chance it comes down here. There is a high chance that it's going to have a bit of a struggle on the 200 moving average, which is here, which is where it did find it. So we have two choices. One choice in this scalping system is to break even the trade here and potentially go for all of the profit that we'd want. Or the other choice is to take some profit off here or to close the position because we know the 200 moving average is going to act as dynamic support. So there's several different ways of managing this. Again, the 1, 2, 3 is the most important section. With the one over here, when a price has broken through the 1, 2, 3, we can see that it got below the 200. So we can trail it by the 50 moving average, and we wouldn't have been stopped out until down here. So that's quite a lot of pips or points in terms of profit. So that's the way you want to do it, and it's that simple. If we have a look at the pound, very similar concept. Now, anybody that is looking at this will know this is a choppy market. It is currently in consolidation after a large move. When it breaks a key zone, and if you look at larger time frames, so let's say we consider this a key break, we're going to jump straight down to the 15-minute charts. We're going to come across to the price, and then again, we're just looking for those 1, 2, 3s. Now, you're not always going to see them, but when they do appear, you're going to take those trades. So here is one that did happen. You got the 1, the 2, the 3. We draw a line across there. When it breaks through, ideally it would come back to roll reversal. We know this is a super aggressive market trend move, so we just buy it when it closes through. And then of course, in terms of the distance that we'd be looking for, what we'd do is we'd take this ranging period. So we basically say this range is the period we want. We wouldn't get it all, but we'd definitely get up to this point. And you can see the market did consider that. Once it gets into the consolidation, notice we have no 1, 2, 3 here. We have no 1, 2, 3 break here. So that would have definitely been a long if this had broken. So we've got that 1, the 2, and the 3. And then we start to see a smoothing of these moving averages, and we're not interested in the trade anymore. The key to it is always waiting for, again, I'll say the 1, 2, 3. It shows the market has considered the level. We're waiting for levels of volatility, like waiting for levels to break. And in highly volatile times like this, when they break, they can be explosive. So next time you're having a look at the charts, even if you're on a 15-minute chart, look for directional trades. So let's say we wanted to short the market. If you saw the market come down, hit a level, hit a level, hit a level, break, and then do this. There's your 1, 2, 3. Take this trade or take the aggressive break. In terms of distance, you'll have to understand a little bit more to take profit. You can definitely do our courses at fxevolution.com to find out more about that. But realistically, this is an amazing entry during these times. So hopefully this helps everybody today, and we'll definitely see you in the next video, and happy trading and hopefully successful trading during this very tough time, guys. We'll see you soon. Bye.